Hi everyone, I just wanted to give an update on the program and an additional sub-strategy that I've put in there. Don't be put off with words like sub-strategy. Something which came about in a conversation with my wife. She said to me, I want big returns though. I want to know, how can I make 1,000 into 3,000? Don't give me the boring stuff. Give me some of the interesting stuff. And she said, if she's interested, she said some of my program users will be interested in it. So even if they're quite cautious, they might put 5% of their capital into this particular strategy. So I said to her, actually, I quite like that notion. And it's something which, when I was doing my show on Bloomberg, I would often talk about this strategy and go through it. Okay, so let me just explain what it is. It's something which within the hedge fund industry we do a lot, and we look at two particular things. One's called the Sortino of a fund, and the other is called the Alpha. Okay, and it's used in my industry. So the biggest hedge fund managers would use this, whether it's George Soros or ourselves. And let me explain what it is. It basically comes down to this. When somebody says, I want big returns, don't bore me, what they actually mean is I want big returns with the least risk of failing to get them, because there's always a risk you might not get that return you're targeting. Okay, so that's what they really mean. They don't realize that's what they mean. That's what they mean. Which, put another way, is I want a stock with, on average, big returns, with the least average probability it actually misses those returns. Now, I'll explain that in a second. And what the Sortino and the Alpha does is it measures this, okay? Because, and I'll explain what I mean because of this. Imagine there's two stocks. Stock A, okay, which in period one, call it 1 year, okay, or 1 month, doesn't matter what, makes 50%. All right, so let's just assume it made 50% in the first year, and stock B made 33%. So obviously you prefer stock A. Okay, the second year, stock A lost 50%, and stock B still generated 33%. In the third year, stock A doubled, and stock B still generated 33%. Which would you prefer? Now, very often, private investors, what happens is they look at this number 50, they look at this number 100, and they say to themselves, God, I want stock A, because look, I know there was a loss there, but that won't happen again. They go, I want those big numbers. The professional hedge fund manager, when I'm speaking to sovereign wealth funds, when I'm speaking to family offices, when I'm speaking to potential investors into my hedge fund, we are trying to show them that we have this. Okay, we have what's called high alpha and high Sortino. I'll explain what those are in a second. All right. Essentially, what they are is that on average we have big returns, and with the least probability of missing those big returns. You can see there we have a big return of 32%, and we kept hitting them on average every year. This had big returns, but on average, it tended to miss them. In fact, here's what's interesting. Its total return was 50%. The total return here was 100%. So the total return here, although it looked year on year not very sexy, actually was double that of stock A. Private investors tend to go into that one. What they should do is go into consistency. And that's what they don't understand. So when my wife says, I want big returns, what she actually means is I want stock B, not stock A. Now, you might say that's obvious. It's only obvious once I explain it. So how do we find these? Well, that's why I'm here, and that's why you have the insights of a hedge fund manager. By the way, long-only fund managers, they haven't got a clue what these are. For many years, for over about 10, 15 years, I sat on the investment committee of Chatham House, which is the world's #1 foreign affairs think tank. Okay, and our patron is Her Majesty the Queen. So I was one of 5 people on the committee whose job it was to make sure that the monies that we have within Chatham House are managed appropriately. And we weren't managing it ourselves. We'd give it to managers such as Cazenove and various other big firms. And you'd ask the long-only fund managers, so, okay, you're putting this into a safe, charitable fund because it's a charity, and we're answerable to the Queen. So what's the alpha or the Sortino of these funds? And they'd just look at you blankly. They wouldn't have a clue. As I've said time and time again, the hedge fund managers such as myself, if I may say so, are the sort of SAS, the elite in the industry, and the long-only fund managers are really, they're nowhere to be seen. So what are Sortino and Alpha? Well, the Sortino, don't be put off by this formula. It has a formula which is based on what the average expected return is and the probability it's going to miss that return. Similarly, Alpha, similar kind of thing, okay? Without going into it too much, I took it as an example, the FTSE 350. I just happened to list it by the stocks which had moved the most in the last 6 months, for argument's sake. Okay, now we ideally want a Sortino preferably above 2, but at least above 1, and we want an Alpha above 1 at the very least, but higher the better. Okay, and obviously you've got my Alpesh value growth rating as well. Now this kind of data I will, because it's not free and it's not freely available, it's my job, because you're part of the program, to make that regularly available. Now one thing you should know is these numbers don't actually change that often, so I don't need to give you a daily update, but I'll make sure within the program the data is there, okay, at regular intervals, and it's all well highlighted and flagged for you, and you can always contact me. That way, on something like this, obviously I start getting interested in that one. I might do more analysis regarding that one because Sortino's above 1, Alpha is 12, it's got a good value growth rating for me as well. And lo and behold, in the last 6 months alone, it was up 44%, okay? I'm still going to put this in the high risk category. Why? Well, it's up to you. You might say, no, Alpesh, that's great. But don't forget, a stock name that comes out of this might also be in, say, strategy 1 or strategy 3 or whatever else. If it's in more strategies, that's fine, that's great. I'm just going to, out of an abundance of caution, because we're looking for a big return in a short space of time, going to put this in a high risk strategy. Now you might say, well, what's your target price then? If it's a performance stock only, these aren't going to be keep forever ones, they're performance only. Well, I would, as a good rule of thumb, say whatever it's achieved in the last 6 months, let's say on a performance basis, we give it 12 months to achieve the same return. So another 44% in the next 12 months. Well, that's not tripling your money, is it? Well, no, that's only because I've shown you the FTSE 350. If I do that for the smaller caps, we'll get more of those numbers as well. And if I showed ones which were American companies, then we'd have that as well. And I will provide that data for you, so don't worry, okay? But I just wanted you to understand this and why we look at it. Probably the two most important criteria used by investors when they're giving money to hedge fund managers. And the kinds of investors who give money are some of the richest people in the world. So the billionaires will, well, it's usually their staff who'll do this, but they will understand what is a Sortino and what is an Alpha, and that is what they want in our funds, okay? So I just wanted to explain that, give that insight to you as well. Thank you very much.